Before we dive in, please remember that I am not a licensed financial advisor, lender, or attorney. This presentation is for informational and educational purposes only. The world of commercial real estate and finance is complex and involves significant risk. Always consult with qualified professionals before making any investment decisions. This video is not financial, legal, or investment advice. You see that 10-unit apartment building on the corner? The one you drive by every day? What if I told you that you could buy it with the same down payment you'd need for a slightly above average single-family home in a decent suburb? It sounds impossible, right? It feels like a different universe of money, a level of wealth reserved for the titans of industry. But it's not. The secret isn't having millions in the bank. The secret is understanding the one financial tool that builds empires, the one thing that separates the hobbyist landlord from a real estate professional: the commercial real estate loan. And here's the brutal truth. Most people who are crushing it with single-family homes and duplexes hit a brick wall the second they try to scale up. They try to apply the rules of home mortgages to the world of commercial property, and it's like trying to use the rules of checkers to play a game of 3D chess. They get rejected by banks, they get confused by the terminology, and they ultimately retreat back to the safety of what they know, leaving generational wealth on the table. This series is your antidote to that confusion. This is the guide I wish I had when I was starting out. We are going to pull back the curtain on the entire commercial lending process from start to finish. We're going to decode the jargon, we're going to build the exact loan package that bankers want to see, and we're going to transform you from an outsider looking in to an insider who can speak the language of finance with total confidence. By the end of this series, you won't just understand commercial loans, you'll know how to get them. So let's start with the single most important mindset shift you have to make. It's the foundation upon which everything else is built. When you got the mortgage for your house, who was the star of the show? It was you. The bank scrutinized every single detail of your life. They wanted to know your FICO score, your income, your job history, your credit card debt, how much you spend on coffee every month. Your personal financial health was everything. They were betting on you to pay them back. In commercial real estate, the bank isn't betting on you. They're betting on the property. Let that sink in. The property itself is the main character. You are just the supporting actor. The bank's primary concern is not your W-2 salary. Their primary concern is, does this building as a standalone business generate enough cash to pay for itself and all of its expenses, including the new loan? This is the golden rule. The property must be able to stand on its own 2 feet. Think of it like this. You're not buying a building, you're buying a small business that happens to be made of bricks and mortar. The rent collected from tenants is the revenue. The property taxes, the insurance, the maintenance, the management fees, those are the operating expenses. What's left over after you pay all those bills is called the net operating income, or NOI. This term, NOI, is the most important acronym in commercial real estate. It is the lifeblood of your investment. It is the number that lenders care about more than almost anything else, because from that net operating income, you have to make your loan payment. This brings us to the second critical concept, the debt service coverage ratio, or DSCR. It sounds intimidating, but the concept is incredibly simple. It's the bank's safety cushion. They take your property's annual net operating income, and they divide it by your total annual loan payments. For example, if your property generates $125,000 a year in NOI, and your total mortgage payments for the year are $100,000, your DSCR is 1.25. This means that for every $1 you owe the bank in mortgage payments, the property is generating $1.25 in profit to cover it. That 25-cent cushion is the bank's margin of safety. It's what lets them sleep at night. If a tenant moves out or a water heater breaks, there's still enough cash flow to make the loan payment. Most banks in the United States will want to see a DSCR of at least 1.20 or 1.25. If your property doesn't meet that minimum threshold, the conversation is over before it even begins. It doesn't matter if you're a billionaire with a perfect credit score. If the property can't pay its own bills, the bank is not interested. Now you might be thinking, if the property is the star, do I even matter? Yes, you absolutely do. This is where another key difference comes in, the personal guarantee. With your home mortgage, if you default, the bank forecloses on the house. With most commercial loans, especially for your first few deals, the bank will require you to sign a personal guarantee. This is a legal promise that if the property, the business, fails and can't make its payments, you will step in and pay the loan back with your own personal assets. Your savings, your investments, even your primary residence could be on the line. It's the bank's way of ensuring you have skin in the game. It makes sure you won't just walk away if things get tough. It's a serious commitment, and it's why understanding your deal inside and out is non-negotiable. Let's talk about the money you need to bring to the table. In the residential world, you hear about FHA loans with 3.5% down, or even VA loans with 0% down. Forget all of that. In the commercial world, that doesn't exist. The amount a bank is willing to lend is expressed as a loan-to-value ratio, or LTV. A typical commercial LTV is between 65% and 75%. That means for a $1 million property, you, the borrower, will need to come up with a down payment of $250,000 to $350,000, plus closing costs. The days of low money down are over. Commercial lending is a pay-to-play game, and the down payment is your price of admission. Another major shock for beginners is the structure of the loan itself. Your 30-year fixed-rate home mortgage is a beautiful, simple thing. You know exactly what your payment will be today, and what it will be 29 years from now. Commercial loans are different. They often have what's called a balloon payment. The loan might be amortized over 20 or 25 years, which means the payments are calculated as if it's a 25-year loan. But the loan itself might be due in full, the entire remaining balance, in just 5, 7, or 10 years. This is called the loan term. So what happens when that balloon payment is due? You don't just pay it off. You either have to sell the property or, more commonly, refinance the loan with a new one. This structure gives the bank a chance to reevaluate the deal every few years. Is the property still performing well? Have interest rates changed? It forces you to stay on top of your game as an owner and operator. Finally, who are you getting this money from? Unlike the residential world dominated by a few big names, the commercial lending landscape is vast and varied. You have the giant national banks like Chase and Bank of America. You have smaller, local community banks and credit unions who have deep knowledge of their specific neighborhoods. You have government-backed programs like SBA 504 and 7A loans, which are fantastic for buying properties for your own business to operate out of. And then you have private lenders and hard money lenders who move quickly but charge much higher interest rates. Finding the right lender is like matchmaking. The big national bank might not even look at a loan under $1 million, while the local community bank down the street might be the perfect partner for your first 6-unit building. The key is to know what kind of deal you have, and then find the lender whose business model aligns with your project. So let's recap the foundational shift. Getting a commercial loan requires you to stop thinking like a home buyer and start thinking like a business analyst. The property is the business. The net operating income is its heartbeat. The debt service coverage ratio is its health score. And your job is to be the competent CEO who can present this business to the bank, the investor, in a way that makes them confident enough to write a very, very large check. This is the framework. This is the new language you need to speak. And once you master this mindset, you've already won half the battle. In the parts to come, we're going to dive deep into each of these components. We'll show you exactly how to calculate NOI, how to build a rock-solid loan proposal, how to navigate due diligence, and how to find and pitch the right lender for your specific deal. You're laying the foundation right now for a completely new chapter in your investment journey. So let's start with the single biggest mental shift you need to make. When you bought your house, the bank's decision was almost entirely about you. Your income, your credit score, your debt-to-income ratio. The house was important, sure, but you were the star of the show. The bank's primary question was, can this person afford to pay us back? In commercial real estate, that question gets flipped on its head. The bank is no longer underwriting you. They're underwriting a business. And that business is the property itself. The number one question a commercial lender asks is, can this property afford to pay us back? Your personal financial strength is still a factor, absolutely. They want to see that you're a strong guarantor. But it's secondary. The property is the primary source of repayment. This is a game changer. It means the property has to stand on its own 2 feet, financially. It has to generate enough income to cover all of its own expenses, the taxes, the insurance, the maintenance, the management, and most importantly, the new mortgage payment you're about to place on it. And not just cover it, but cover it with a healthy margin of safety. This is why someone with a modest personal income can get a multi-million-dollar commercial loan, while someone with a huge income might get denied. If the property's numbers don't work, the deal doesn't work. Period. Your W-2 from your day job can't save a bad deal. The property is the business, and the loan is essentially a business loan. Understanding this unlocks the entire universe of commercial lending. So, who are the players in this universe? Who are you actually getting the money from? It's a much broader world than just going to Chase or Bank of America. First, you have the big guys, the large national banks. They're predictable, they're everywhere, and they typically want to see larger, more stable, vanilla deals. Think of fully leased office building in a major city or a big apartment complex. They have stricter boxes they need to check, but they can offer competitive rates. Then you have what many consider the sweet spot for new investors: regional and community banks. These lenders live and breathe the local market. They know the neighborhoods, they understand the local economy, and they often have more flexibility. They're building a relationship with you, not just processing a transaction. If you're buying your first 10-unit apartment building or a small retail strip center, the local community bank is often your best first call. They are relationship-driven. Next up, you have CMBS lenders. CMBS stands for Commercial Mortgage-Backed Securities. This is a different beast entirely. Think of it as Wall Street getting into the commercial loan business. These are often called conduit loans. A conduit lender will pool your loan together with hundreds of other commercial loans and sell them off as bonds to investors. Because of this structure, they can often offer very attractive, fixed-rate terms, especially for longer periods. The trade-off? They are incredibly rigid. Once the loan is made, it's packaged and sold. There's very little flexibility for changes down the road, and the prepayment penalties can be severe. These are for stable, long-term holds where you don't anticipate needing to sell or refinance anytime soon. You also have life insurance companies. Yes, the same companies that sell life insurance are some of the biggest commercial real estate lenders in the country. They are extremely conservative. They are looking for the absolute best properties in the best locations with the best tenants, what they call trophy or Class A assets. They offer fantastic long-term, fixed-rate financing, but they are very selective. For a beginner, this is likely not your starting point, but it's crucial to know they exist as you grow. And of course, you have private and hard money lenders. These lenders are all about speed and flexibility. The property doesn't generate enough income yet? Does it need significant renovations? Do you have credit issues? A bank might say no, but a hard money lender might say yes. They are funding the opportunity, the story of the deal. The price for this speed and flexibility is much higher interest rates and fees. This is a short-term tool, not a long-term solution. You use a hard money loan to acquire and fix a property, then refinance out into a more stable, long-term loan from a bank once the property is stabilized. Okay, so you know the mindset and you know the players. Now, what language do they all speak? No matter which lender you approach, they are all going to evaluate your deal based on two sacred, non-negotiable metrics. You need to know these numbers inside and out. They are loan-to-value or LTV, and the debt service coverage ratio or DSCR. Let's start with the easy one, loan-to-value LTV. This is simply the percentage of the property's value that the bank is willing to lend you. If you're buying a property for $1 million and the bank offers a 75% LTV loan, they will lend you $750,000. You are responsible for coming up with the remaining $250,000 as the down payment plus closing costs. Simple enough. For commercial properties, LTVs typically range from 65% to 80%, depending on the property type, location, and the strength of the deal. A riskier property like a hotel might get a 65% LTV, while a stable apartment building in a great area might get 75% or even 80%. Now for the second metric, the one that truly separates the amateurs from the pros. This is the one that will make or break your loan application. It's the debt service coverage ratio, or DSCR. While LTV tells the bank how much skin you have in the game, DSCR tells the bank if the property can actually afford to pay the mortgage. It is the single most important metric in commercial loan underwriting. Here's the formula. DSCR equals net operating income divided by total debt service. Let's break that down. Net operating income, or NOI, is all the income the property generates, from rents, laundry, parking, whatever, minus all of its operating expenses. Operating expenses are things like property taxes, insurance, management fees, repairs, utilities, and landscaping. It's important to note, NOI is calculated before you factor in the mortgage payment. It's the pure, unlevered profit of the building itself. Total debt service is just a fancy way of saying your total mortgage payments for the year, principal and interest combined. So the DSCR formula, NOI divided by debt service, creates a ratio. This ratio shows the lender how many times over the property's annual profit can cover the annual mortgage payment. Let's use an example. Imagine you're buying a small apartment building. After collecting all the rents and paying all the bills, taxes, insurance, maintenance, the property is left with a net operating income of $50,000 for the year. That's your NOI. Now, let's say the new mortgage you're trying to get will have total annual payments of $40,000. That's your debt service. To get the DSCR, you take the NOI of $50,000 and divide it by the debt service of $40,000. The result is 1.25. Your DSCR is 1.25x. What does this 1.25x mean? It means that for every $1 you owe the bank in mortgage payments, the property is generating $1.25 in profit to cover it. That extra 25 cents is the lender's safety cushion. It's a buffer. It means that even if your operating expenses unexpectedly increase, or you have a vacancy and your income drops by up to 25%, you would still have just enough money to pay the mortgage. If your DSCR was 1.0x, it would mean your NOI was exactly equal to your debt service. You'd be breaking even. There is zero room for error. A single unexpected repair could mean you can't make your loan payment. No lender wants that. That's why virtually every lender has a minimum DSCR requirement, and it's almost always higher than 1.0. For most property types, lenders want to see a DSCR of at least 1.20x or, more commonly, 1.25x. For properties they consider riskier like a restaurant or a hotel, they might require a DSCR of 1.40x or even higher. This number is everything. You can have a great personal credit score and a huge net worth, but if the DSCR on the property you want to buy is 1.10, you will get rejected by almost every conventional lender. The property itself doesn't demonstrate the ability to safely repay the loan. Mastering LTV and DSCR is your first major step towards sounding like you know what you're doing when you talk to a lender. You can analyze a deal through their eyes. You can quickly see why one property is financeable and another isn't. You can stop wasting time on deals that are dead on arrival and focus on the ones that have a real shot. These two metrics are the foundation of the entire commercial loan analysis. But they are just the beginning. They determine how much you can borrow and if you can borrow. But they don't tell you about the structure of the loan itself. We're talking about things like the amortization period, the loan term, whether it's a fixed or variable interest rate, and the concept of a balloon payment. These are the components that shape how the loan actually behaves over its life, and they have a massive impact on your cash flow and your overall investment strategy. Understanding them is the difference between getting a good loan and getting a truly great loan that sets you up for success. Let's start with the first concept, amortization. It sounds complicated, but the idea is simple. Think of your loan as a giant pizza. Amortization is simply the plan for how you're going to eat that pizza, slice by slice, over a set period of time until it's all gone. In finance, every slice or every monthly payment you make is composed of two ingredients: principal and interest. Principal is the real money you borrowed. It's the part of the payment that actually reduces your loan balance. Interest is the fee you pay the lender for the privilege of using their money. Now, here's the crucial part that trips up so many beginners. The ratio of principal to interest in each payment changes dramatically over the life of the loan. In the early years, your payments are overwhelmingly interest. You're paying the bank for their risk. A huge portion of that check you write every month goes straight into the lender's pocket, while only a tiny sliver chips away at the actual loan amount. It can feel like you're running in place. But as time goes on, a beautiful thing happens. With each payment, your loan balance gets a little smaller. Because it's smaller, the interest calculated on that balance for the next month is also a little smaller. And since your total monthly payment amount is fixed, that extra money automatically gets applied to the principal. It's like a snowball rolling downhill. It starts small, but over time, the amount of principal you're paying off each month gets bigger and bigger, accelerating how quickly you build equity in your property. The length of this process is called the amortization period. For commercial loans, this is often 20, 25, or even 30 years. A longer amortization period means smaller monthly payments, because you're stretching the pizza-eating plan over a longer time. But it also means you'll pay significantly more in total interest over the life of the loan. Let's put some real numbers on this. Imagine you get a $1 million loan with a 25-year amortization period at a 7% interest rate. Your fixed monthly payment for principal and interest would be around $7,068. In your very first month, guess how much of that payment is interest? A staggering $5,833. That means only about $1,200 of your $7,000 payment actually went towards paying down your $1 million debt. You just made a huge payment, but your loan balance barely budged. Now let's fast forward 5 years. you've been making that same payment month in and month out. By now, your loan balance has been chipped away to around $940,000. For your next payment, the interest portion is now calculated on this smaller balance. It comes out to about $5,480. Since your total payment is still $7,068, the amount going to principal has now grown to almost $1,600. Still mostly interest, but you can see the shift. The snowball is picking up speed. After 20 years, that same $7,000 payment would be mostly principal, with only a small amount going to interest. That's the power and the patience of amortization. Okay, so you understand amortization. It's the 25-year plan to pay off the loan. Simple enough, right? Well, here comes the single biggest curveball in commercial real estate finance, and it's the concept that separates it from the simple 30-year fixed mortgage you might have on your house. This is the difference between the amortization period and the loan term. While your payments might be calculated as if you're going to pay off the loan over 25 years, that's the amortization. The bank is almost never going to actually wait 25 years to get all their money back. Instead, they give you a much shorter loan term, also known as the maturity date. This is the actual deadline for when the loan must be paid back in full. Common loan terms in commercial real estate are 5, 7, or 10 years. Think of it like this. The amortization is the pacing guide for a marathon, setting a comfortable, steady monthly payment. But the loan term is a mandatory, all-out sprint at mile 10. The bank is telling you, we will calculate your payments at a 25-year marathon pace so you can afford them, but we demand that you cross the finish line in 10 years. You can immediately see the problem. If you're only paying a small amount of principal each month based on a 25-year schedule, how on earth are you supposed to pay off the entire remaining balance at the end of year 10? The answer is something called a balloon payment. And it's exactly what it sounds like. A massive, inflated final payment that covers the entire remaining principal balance of your loan. After you've made your regular monthly payments for 5, 7, or 10 years, the lender turns to you and says, okay, time's up. The remaining balance is now due. All of it. Right now. Let's go back to our $1 million loan. You have a 25-year amortization but a 10-year term. For 10 years, you diligently make your monthly payment of $7,068. At the end of that 10-year term, you will have paid down some principal, but you will still owe the bank an enormous sum, somewhere around $820,000. That is your balloon payment. You have to come up with over $800,000 in cash on a specific date. This is, without a doubt, the riskiest and most important feature of most commercial loans. It's a ticking clock that starts the moment you sign the papers. So why do banks do this? Why create this high-pressure situation? It's all about managing risk. The world can change a lot in 25 or 30 years. Interest rates can skyrocket, markets can crash, and properties can fall into disrepair. A lender doesn't want to be locked into a 7% interest rate for 30 years if prevailing rates jump to 12%. The shorter loan term allows the bank to reevaluate the deal every 5 or 10 years. It forces you, the borrower, to come back to the table, allowing the bank to adjust the interest rate to current market conditions, reassess the property's value, and check on your financial health. It's a safety valve for the lender. So what does this mean for you, the investor? It means you must have an exit strategy for your loan before you even take it out. When that balloon payment comes due, you generally have 3 options. First, you could sell the property. Ideally, the property has appreciated in value, and you can sell it, pay off the $800,000 balloon payment, and walk away with a hefty profit. Second, you could pay the balloon payment in cash. For most investors, coming up with that kind of liquidity isn't feasible or desirable. So that leaves the third and most common option: you refinance. This means you go out and get a brand new loan to pay off the old one. You might go back to the same bank or to a new one, and you essentially start the process over, hopefully with a property that's worth more and generating more income than when you started. But refinancing comes with its own set of risks. What if interest rates are much higher when your term is up? Your new, higher monthly payment could destroy your cash flow. What if property values in the area have fallen? The bank might not be willing to lend you enough to cover the balloon payment, forcing you to come up with a difference in cash or risk foreclosure. This is called refinancing risk, and managing it is a core skill of any successful commercial real estate investor. You have to be thinking about your 10-year balloon payment on day one. So we've untangled the structure. We have the amortization, which sets the monthly payment amount, and the term, which sets the due date, creating the need for a massive balloon payment. This fundamental structure underpins almost every commercial loan you'll encounter. But there's another critical layer we have to add to this model: the interest rate itself. We've been assuming a fixed 7% rate in our example, where the payment never changes. But what if it did? What if your interest rate could change every year, or even every month, tied to the whims of the global economy? This introduces a whole new level of complexity and risk. You could have a loan with a 25-year amortization and a 10-year term, but the rate itself could be a moving target. These are known as floating or variable rate loans. Understanding how these rates work, and how they differ from the stability of a fixed-rate loan, is the next crucial piece of this puzzle. So let's dive headfirst into that moving target. Imagine you're planning a cross-country trip. You have two main options. The first is a train on a fixed track. You know the exact route, the exact speed, and the exact arrival time. It's predictable, it's safe, and there are no surprises. This is your fixed-rate loan. The second option is a high-performance car. It's faster, more exciting, and could get you there sooner, saving you time and money. But the road ahead has variable speed limits, potential detours, and the price of gas could skyrocket mid-journey. This is your floating or variable rate loan. It offers the potential for a better deal, but it comes with a dose of uncertainty you have to be prepared to manage. A variable rate commercial loan isn't just a random number a lender pulls out of a hat each month. It's a calculated formula with two key ingredients: the index and the margin. First, the index. Think of the index as the wholesale cost of money. It's a benchmark interest rate that reflects the general economic conditions, and it moves up and down with the market. Lenders don't control this. It's set by broad financial forces. For decades, the most common index was something called LIBOR, the London Interbank Offered Rate. You've probably heard of it. But LIBOR had some serious problems and was phased out. Today, in the United States, the dominant index you'll see is SOFR, which stands for the Secured Overnight Financing Rate. SOFR is considered a more robust and transparent benchmark, based on actual transactions in the U.S. Treasury market. Another common index, especially for smaller banks, is the prime rate, which is heavily influenced by the Federal Reserve's federal funds rate. So, when you hear on the news that the Fed raised rates, it directly impacts the prime rate and in turn the cost of any loan tied to it. The index is the variable part of your variable rate loan. It's the shifting road conditions on your car trip. The second ingredient is the margin, sometimes called the spread. This part is much simpler. The margin is the lender's profit. It's a fixed percentage that the bank adds on top of the index. This margin is determined when you sign the loan, and it does not change for the life of the loan. It's based on the lender's assessment of your risk, the quality of your property, your financial strength, your business plan, and so on. So the formula is simple. Index rate plus margin equals your total interest rate. Let's make this real. Suppose you get a loan where the index is SOFR, and the lender's margin is 2.5%. If SOFR is currently at 5%, your total interest rate is 7.5%. Simple enough. But what happens next month if economic news causes SOFR to jump to 5.5%? Your margin stays the same at 2.5%, but now your total interest rate is 8%. Your monthly payment just went up. Conversely, if the economy slows and SOFR drops to 4%, your rate falls to 6.5%, and you're saving money. You are directly participating in the fluctuations of the financial markets. So why on earth would anyone choose this roller coaster? The primary allure is a lower initial rate. Lenders price the immediate risk, and since they aren't locking in a rate for 10 years, they can offer a lower starting rate on a variable loan compared to a fixed-rate loan. If you believe interest rates are heading down, a variable rate loan is incredibly attractive. You're essentially betting that the market will move in your favor. And if you're right, your borrowing costs will decrease over time, boosting your cash flow. It's also a great option for short-term holds. If you're a real estate investor planning to buy a building, make some quick improvements, and sell it in 18 months, you're not particularly concerned about where interest rates will be in 5 years. You just want the lowest possible cost of capital right now. But the danger is just as real as the opportunity. This is the part that keeps seasoned investors up at night. If you're wrong and rates start to climb, your loan payments can increase dramatically. This is called payment shock, and it can be devastating. Imagine you've carefully calculated your property's financials. You know your rental income, your taxes, your insurance, your maintenance costs. You have a healthy profit margin. But then, over the course of a year, your index rate climbs 2 or 3%. Suddenly, your single biggest expense, your mortgage payment, has ballooned. Your profit margin vanishes. You might even find yourself in a negative cash flow situation, where you have to feed the property money out of your own pocket each month just to stay afloat. This is how properties get lost. Because of this risk, Lenders don't just hand out variable rate loans with no protections. They often build in safeguards both for themselves and for you. The most common is an interest rate cap. A cap is exactly what it sounds like, a ceiling on how high your interest rate can go. There are two main types. A periodic cap limits how much the rate can increase in a given period, say no more than 1% in a year. A lifetime cap sets an absolute maximum rate for the entire loan term. For example, your loan might start at 7% but have a lifetime cap of 12%. No matter how high the index skyrockets, your rate will never exceed that ceiling. This cap is a form of insurance, and like any insurance, it's not free. You'll either pay a slightly higher margin or an upfront fee to get this protection. But for many borrowers, that peace of mind is worth every penny. For larger, more complex deals, you might encounter something called an interest rate swap, where you essentially swap your variable rate with another party for a fixed rate. But for most beginners, the key takeaway is to understand rate caps and to always ask if your loan has them. There's also a very popular middle ground, the hybrid loan. You've likely heard of these in the residential world as ARMs, or adjustable rate mortgages. In commercial real estate, they are incredibly common. A hybrid loan is fixed for an initial period and then becomes variable. You might see them structured as a 5/1, 7/1, or 10/1 loan. A 7-to-1 loan, for example, has a fixed interest rate for the first 7 years. After that, the rate adjusts once per year based on the current index plus your margin. This can be the best of both worlds. You get the stability and predictability of a fixed rate during the crucial early years of your investment, allowing you to establish the property's performance. But you also get a lower initial rate than you would on a fully fixed 10 or 15-year loan. Now let's get back on that train, the safe, predictable fixed-rate loan. Here, the interest rate you sign on day one is the exact same interest rate you'll pay every single month until the loan is due. It's simple, it's stable, and it's beautiful for long-term planning. You can budget with absolute certainty. You know your biggest expense is locked in. If market rates go to the moon, it doesn't matter to you. You're protected. This peace of mind is the number one reason borrowers choose a fixed rate. But that security comes at a price. The initial rate on a fixed-rate loan will almost always be higher than the starting rate on a comparable variable rate loan. The lender is taking on all the future interest rate risk, and they charge a premium for that. And there's another, often overlooked, cost to fixed-rate commercial loans that can be a brutal surprise for newcomers: prepayment penalties. In the residential world, you can usually pay off your mortgage anytime you want. In the commercial world, it's a different game. Because the lender has guaranteed you a specific rate for a long period, they are counting on receiving that stream of interest payments. If you try to pay off the loan early, perhaps because you sold the property or because rates have dropped and you want to refinance, they will charge you a significant penalty. There are two common types you must know. The first is called yield maintenance. In simple terms, it forces you to pay the lender the difference between your current interest rate and today's lower market rates for the remainder of your loan term. It guarantees they get the yield they were expecting. The second, more common in loans that get bundled and sold as securities, is called defeasance. This is even more complex, but it involves you buying a portfolio of government bonds that generates the exact same cash flow as your remaining mortgage payments. Both of these methods can result in penalties that are tens or even hundreds of thousands of dollars. They are designed to make refinancing unattractive unless interest rates have fallen dramatically. It's the price of certainty. So the choice between fixed and variable isn't just about numbers. It's about your strategy and your tolerance for risk. Are you a short-term player looking for the lowest possible cost now, willing to bet on the market? Or are you a long-term investor who values stability and predictable cash flow above all else? Understanding this fundamental choice, the car versus the train, is the foundation upon which your entire financing strategy will be built. Now that you understand the structure of these rates, the next question is, how does a lender decide what specific rate, what margin, and what terms to offer you? It's not random. It's a detailed process of evaluation called underwriting, where they put your deal, and you personally, under a microscope. So let's pull back the curtain on this process. Underwriting isn't some secret, mystical ritual performed in a dark room. It's a logical, risk-based investigation. The lender is about to hand over hundreds of thousands, or more likely millions of dollars. They need to be confident they're going to get it back with interest. They do this by stress testing your deal from every conceivable angle, focusing on three core pillars: the property itself, you the borrower, and the market the property sits in. Get these three things right and you're golden. Get one wrong and you might still get a deal, but it's going to cost you. Get two wrong and you're probably out of luck. Let's start with the most important pillar, the property. This is the star of the show. If the property can't stand on its own 2 feet, nothing else matters. The lender's number one question is, does this building generate enough cash to pay for itself, with a healthy cushion left over? To answer this, they use the single most important metric in all of commercial real estate lending, the debt service coverage ratio, or DSCR. Don't let the jargon intimidate you. It's an incredibly simple concept. Debt service is just a fancy term for your total annual mortgage payments. The DSCR simply compares the property's net operating income, that's all the rent you collect minus all your operating expenses, to its annual mortgage payment. Imagine your property generates $125,000 a year in net operating income, or NOI. And let's say your total mortgage payments for the year, your debt service, are $100,000. You take the income, $125, and divide it by the debt, $100. The result is $1.25. That's your DSCR. It means your property generates $1.25 of income for every $1 of debt it has to pay. It can cover its mortgage payment, with a 25% safety buffer left over. This buffer is everything to a lender. What if a tenant moves out unexpectedly? What if the roof starts leaking and you need a $15,000 repair? That 25% buffer is what keeps you from defaulting on your loan. It's the shock absorber for the investment. That's why virtually every lender will require a minimum DSCR, typically somewhere between 1.20x and 1.35x. If your deal can't hit that number, it's almost always a non-starter. The second key property metric is the loan-to-value ratio, or LTV. This measures how much skin you have in the game. If you're buying a property for $1 million and you're asking for a $700,000 loan, your LTV is 70%. You're putting in 30%, the lender is putting in 70%. This is crucial. It tells the lender how much of a financial cushion there is if the property's value were to drop. In that scenario, the property's value would have to fall by a full 30% before the lender's portion of the investment is even at risk. Your equity, your down payment, acts as a shield for their capital. For most stable, income-producing properties, you can expect lenders to cap out at a 65% to 75% LTV. They want you to have a significant financial stake in the success of the deal. Beyond the numbers, the underwriter is also looking at the qualitative aspects of the property. What is it? A 200-unit apartment complex with a waiting list is a world away from a half-empty suburban office building from the 1980s. They'll analyze the rent roll in excruciating detail. Who are the tenants? Are they strong, creditworthy national companies like Walgreens or Chipotle on long-term leases? Or are they small, local businesses on month-to-month agreements? A building full of credit tenants is seen as a much safer bet because the income stream is more predictable and secure. Now for the second pillar, you, the borrower. In commercial real estate, you're often called the sponsor. While the property is the primary source of repayment, the lender knows that a property doesn't run itself. A great property in the hands of an incompetent operator can quickly become a disaster. So, they underwrite you just as hard as they underwrite the building. First, they look at your experience. Have you done this before? Do you have a track record of successfully owning and operating this type of property? If you're trying to buy your first 50-unit apartment building, they'll scrutinize your background. Do you have any relevant real estate experience? A strong property management team in place? If you can't show a history of success, they see you as a major variable, a risk that needs to be managed. This is why many people start by partnering with more experienced sponsors. Next, they put your personal finances under a microscope. You'll be required to submit a detailed personal financial statement, or PFS. This document lists all your assets, cash, stocks, other properties, and all your liabilities, mortgages, car loans, credit card debt. From this, they calculate two critical figures: your net worth and your post-close liquidity. Net worth is your total assets minus your total liabilities. It's the 30,000-foot view of your financial health. Lenders often have a requirement that your net worth be at least equal to the loan amount. So, for a $1 million loan, they want to see a net worth of at least $1 million. This shows them you are a person of substance who has successfully managed finances in the past. But even more important is your liquidity. This is the amount of cash or easily sellable assets you have. Specifically, they want to know your post-close liquidity. How much cash will you have left in the bank after you've paid your down payment and all your closing costs? Lenders need to know that if the property's boiler explodes 6 months after you buy it, You have the personal cash reserves to fix it without missing a mortgage payment. They aren't just lending to the property. They're lending to your ability to support that property when things go wrong. A lack of post-close liquidity is one of the most common deal killers for aspiring investors. Finally, we have the third pillar, the market. A fantastic property with a great sponsor can still fail if it's in a terrible market. The underwriter becomes a student of demographics and economics. They are looking at the health of the city, the county, and even the specific neighborhood or submarket where the property is located. Are people moving to this city or are they leaving? Is the population growing? Are major employers like Amazon or Toyota opening up new facilities and creating jobs? Or is the town's single largest employer a factory about to shut down? They will pull detailed third-party reports that analyze job growth, population trends, and household income levels. Then they zoom in on the property's immediate vicinity. What's the competition like? If you're buying an apartment building, are there 3 brand new complexes being built on the next block? That new supply could make it harder for you to raise rents or even keep your building full. If you're buying a retail center, what's the traffic count on the main road? Is the area vibrant and growing? Or are there vacant storefronts everywhere? The strength of the market provides the tailwind that can make a good deal great, or the headwind that can sink an otherwise decent property. So the underwriter takes these 3 pillars, the property's cash flow, the borrower's strength, and the market's fundamentals, and puts them all together. They are building a story, a detailed forecast of what the next 5 or 10 years of this investment will look like. A strong deal with a high DSCR, a low LTV, an experienced sponsor with deep pockets, located in a booming market? That's an A+ deal. It's going to get the best interest rate, the most flexible terms, and a smooth closing process. A deal with the rookie sponsor in a shaky market. Even with a decent property, the lender might still do it, but they'll compensate for that increased risk by charging a higher interest rate, requiring a larger down payment, or demanding you set aside a large cash reserve. Every piece of the puzzle affects the final offer. So, now that you know how the lender thinks, how they analyze risk and structure a deal, what kind of loan should you actually be asking for? Because not all loans are created equal. You have permanent loans, bridge loans, construction loans, and choosing the right one can make or break your entire investment. That's exactly what we're breaking down next. Let's start with the most common, the one you're probably most familiar with from the residential world. The permanent loan. Think of this as the 30-year mortgage of commercial real estate. It's the settle down and get comfortable loan. This is the financing you get for a stabilized, cash-flowing property. A building that's already doing its job. Imagine a 10-unit apartment building that's fully leased, or a strip mall with tenants like Subway and a nail salon on long-term leases. The property is proven. It's generating consistent income, and there are no major renovations or wild cards on the horizon. For a deal like this, a lender is happy to offer a permanent loan, often called perm financing. Why? Because the risk is relatively low. The property's track record, its rent roll, and its operating history all provide a clear picture of its financial health. This lower risk translates into better terms for you, the borrower. You'll typically see longer amortization periods, anywhere from 20 to 30 years, which means your monthly payments are spread out and more manageable. You'll also get the lowest interest rates. These are often fixed for a period of 5, 7, or 10 years, giving you incredible predictability in your cash flow. You know exactly what your biggest expense will be for years to come, which is a massive advantage for any investor. The lenders for these loans are usually traditional institutions, your local and national banks, credit unions, and for larger deals, you might see life insurance companies or what are called CMBS lenders, commercial mortgage-backed securities. The key takeaway for permanent loans is this: they are for finished products. If your business plan is simply to buy a solid, income-producing asset and hold it for the long term, the permanent loan is your best friend. But what if the property isn't a finished product? What if its best days are ahead of it? What if you're looking at an office building that's only 50% occupied, with outdated interiors and deferred maintenance? It's bleeding cash right now, but you have a vision. You see that with $100,000 in renovations and a smart leasing strategy, you can get it to 95% occupancy within 18 months and double its value. No traditional bank is going to give you a low-interest 30-year permanent loan for that. The property doesn't qualify. It's not stabilized. This is where the bridge loan comes in. It's called a bridge loan because that's exactly what it does. It builds a bridge from the property's troubled present to its profitable future. It's a short-term, flexible financing tool designed specifically for these value-add projects. A bridge lender isn't underwriting the property as it is today. They are underwriting your vision for what it will be tomorrow. They're betting on you and your business plan. Because they're taking on more risk, the terms are very different. Bridge loans are short, typically 1 to 3 years. The interest rates are significantly higher than a permanent loan, and they're almost always floating, meaning they move up and down with a benchmark rate. To help with cash flow during your renovation and lease-up period, these loans are often structured as interest only. This means your monthly payment is much lower because you're not paying down any principal. You're just covering the interest, which frees up capital to pour back into the property. The most critical part of any bridge loan application is the exit strategy. The lender needs to know with crystal clarity how you plan to pay them back in 24 months. There are usually 2 paths. You either sell the newly stabilized, much more valuable property for a profit, or you refinance. That's the classic strategy. You use the bridge loan to fix the property, and once it's fixed and fully leased, once it's stabilized, you then qualify for that cheap, long-term permanent loan we just talked about. You use the permanent loan to pay off the expensive bridge loan, and now you're left with a cash-flowing asset in stable financing. The bridge was the tool that got you from point A to point B. Now let's take it one step further. What if there is no building at all? What if you've just got a piece of empty land, a set of architectural drawings, and a dream to build a brand new self-storage facility? You can't get a permanent loan because there's no income. You can't even really get a bridge loan because there's nothing to renovate. For this, you need a construction loan. This is the most complex and highest risk category of lending, and the process reflects that. A construction lender is essentially your financial partner throughout the entire building process. Unlike other loans where you get a lump sum of cash at closing, a construction loan is paid out in stages called draws. You don't get all the money at once. Here's how it works. You close on the loan, and the lender gives you the first draw to clear the land and pour the foundation. Once that work is complete, the lender will literally send an inspector to the site to verify that the work has been done correctly and according to the plans. If it all checks out, they release the next draw for the framing, then another inspection, and the next draw for the rough plumbing and electrical. This process continues: inspection, draw, all the way until the project is finished and you receive a certificate of occupancy. This hands-on approach protects the lender. They're ensuring their money is being used as intended and that the asset is actually being created. Because of this high level of risk and involvement, construction loans have the highest interest rates and fees. You'll be paying interest only on the money that has been drawn out, not the full loan amount, which helps. But to even get approved, your application package has to be bulletproof. We're talking detailed architectural plans, city permits, a line-item budget that's been vetted and approved, and a signed contract with a reputable general contractor. The lender is scrutinizing every single detail before they risk a dollar. Just like a bridge loan, the exit strategy is paramount. Once the building is complete and you start signing up tenants, you'll typically look to refinance out of the expensive construction loan and into a long-term permanent loan. Many lenders even offer a product called a construction-to-perm loan that automatically converts once the project is stabilized, simplifying the process. So we have permanent loans for finished products, bridge loans for fix and flips, and construction loans for building from scratch. Those are the big 3. But there's one more category worth knowing. A sort of special teams player you bring in for unique situations. The hard money loan. If a bridge loan is for a property a bank won't touch, a hard money loan is for a property a bridge lender won't touch. This is asset-based lending in its purest form. Hard money lenders are typically private individuals or small funds. They care very little about your credit score, your tax returns, or your personal income. They care about one thing and one thing only: the value of the real estate. They'll lend you a percentage of the property's value. And if you don't pay, they're more than happy to foreclose and take the property. It's the fastest but also the most expensive money you can get. You can often close a hard money loan in a matter of days, not weeks or months. But you will pay for that speed. We're talking very high interest rates, often in the double digits, plus several points, which are upfront fees. Point is 1% of the loan amount. So a 3-point fee on $1 million loan is an extra $30,000 you pay at closing. This is the financing you use when speed is the only thing that matters, or when the deal is so unusual that no other lender will even look at it. It's a scalpel, a highly specialized tool for very specific circumstances, not a long-term solution. Choosing the right loan isn't just about getting the best rate. It's about aligning the financing with your business plan. Using a permanent loan for a major renovation project is impossible. Using a bridge loan for a stabilized asset is incredibly expensive and inefficient. It's like using a race car to haul groceries. The tool has to match the job. So now you understand the different tools in your toolkit. You've identified your property, you have a solid business plan, and you've picked the right loan type to execute that plan. You're ready to approach a lender. But what do they actually want to see? What goes into the loan application package that separates the amateurs from the pros? We're about to pull back the curtain on the underwriting process, revealing the exact documents and metrics lenders use to say yes or no. And I'll share the one document that most beginners get wrong, that can single-handedly kill your deal before it even starts. That's coming up next. Alright, let's pull back the curtain. You've found a property, you've talked to a lender, and they've given you a term sheet. Now you enter the most critical and often misunderstood phase of the entire loan process, underwriting. This is where the bank puts your deal under a microscope. It's not a negotiation anymore. It's an investigation. They are looking for one thing, the truth. And your job is to present that truth in a way that screams low risk. Think of underwriting as two separate, but equally important job interviews happening at the same time. The first interview is for the property itself. Does it have the qualifications to get the job of paying back the loan? The second interview is for you, the sponsor or guarantor. Do you have the financial strength and experience to be the boss of this property? The bank needs to say yes to both. A stellar property can't save a weak borrower, and a billionaire borrower can't always save a failing property. Both have to pass the test. So let's start with the property's interview. The lender will ask for a core set of documents to understand its financial story. The first is the rent roll. This is a snapshot in time. It lists every tenant, the space they occupy, their monthly rent, and crucially, when their lease expires. A lender looks at this and immediately starts assessing risk. Are all the tenants in one industry? If that industry has a downturn, you could face mass vacancies. Do a few big tenants make up most of the income? If one leaves, the property could sink. Are a lot of leases expiring in the next year? That's a huge risk for the lender, because it creates uncertainty about future income. A strong rent roll shows a diverse mix of tenants with staggered lease expirations. Next, the lender will ask for the T12, which stands for trailing 12-month profit and loss statement. If the rent roll is a snapshot, the T12 is a one-year historical video. It shows every dollar that came in: rent, laundry income, parking fees, and every dollar that went out: taxes, insurance, maintenance, management, utilities. This is the property's real-world performance. Its report card. There's no hiding here. The numbers are the numbers. And this brings us to the single document that I see beginners get wrong more than any other. The one that can poison the well and get your application tossed in the trash before it's even seriously considered. It's not the T12, it's not the rent roll. It's the pro forma. A pro forma is your projection of how the property will perform in the future under your ownership. And this is where the fantasy begins. A beginner will create a pro forma that shows rents jumping by 30% in the first year, expenses mysteriously being cut in half, and vacancy dropping to zero. They think they're selling the lender on the potential. But what the lender actually sees is a person who is either dangerously naive or deliberately trying to mislead them. Both are massive red flags. A commercial underwriter has seen thousands of deals. They live and breathe operating expenses for their market. They know that property taxes don't just get cut. They know that you can't manage a 50-unit apartment building for $500 a month. When they see your fantasy pro forma next to the property's actual T12, the gap between your dream and reality looks like a credibility canyon. They won't believe any of your other numbers. Your deal is dead. The secret is to create a pro forma that is grounded in reality. It should be a direct, logical evolution of the T12. If you plan to raise rents, you need to provide proof, like a detailed rent comparable analysis showing nearby properties are already achieving those rents. If you plan to cut expenses, you need to explain exactly how. Are you bringing in a new management company? Provide their quote. Are you appealing the property taxes? Show the documentation. Your pro forma should tell a believable story of improvement, not a fairy tale. It should be the bridge from the property's past to its profitable future, and every plank in that bridge must be supported by evidence. So once the property passes its interview with a solid rent roll, a verifiable T12, and a realistic pro forma, the spotlight turns to you. Now it's your interview. The first document they'll demand is the Personal Financial Statement, or PFS. This is your financial report card. It's a simple balance sheet listing everything you own: cash, stocks, real estate, retirement accounts, and everything you owe: mortgages, car loans, credit card debt. The lender is looking at two key things here: net worth and liquidity. Net worth is your total assets minus your total liabilities. Lenders typically want to see a borrower's net worth be at least equal to the size of the loan. So for $1 million loan, they want you to have a net worth of at least $1 million. It's a psychological backstop for them. It shows you have substance and are a serious person of means. But even more important than net worth is liquidity. Liquidity is cash or assets that can be turned into cash very quickly. This is the lender's ultimate safety net. If the property has a few bad months and can't make the mortgage payment, do you have enough cash in the bank to cover it? They want to see post-closing liquidity, meaning after you've paid the down payment and all the closing costs, you still have enough cash on hand to cover at least 6 to 12 months of total debt service. This proves you can weather a storm. Next up is your resume, which in the real estate world is called the Schedule of Real Estate Owned, or SREO. This is a list of every property you currently own. It details when you bought it, what you paid, what it's worth now, the current mortgage balance, and the net operating income it produces. This document tells the lender if you're a rookie or a veteran. If you're buying a 20-unit apartment complex, and your SREO shows you already own a duplex and a fourplex that you've managed successfully for years, that gives them confidence. You've done this before. If your SREO is blank, it doesn't kill the deal, but it means the lender will scrutinize everything else that much harder. They might require a larger down payment or mandate you hire a professional third-party manager. Your experience or lack thereof directly impacts their assessment of risk. Finally, to verify everything you've claimed on your PFS and SREO, they'll ask for the ultimate proof: your tax returns and bank statements. They'll typically want the last 2 to 3 years of personal and business tax returns. They're cross-referencing everything. Does the income you claim on your PFS match what you reported to the IRS? Does the rental income on your Schedule E tax form match the performance you claim on your SREO? Any discrepancy is a huge problem. Then they'll ask for 2 or 3 months of bank statements to prove your liquidity. The cash you claimed on your PFS better be sitting in the account you show them. This is the final verification. It's where you prove you are who you say you are. Only after the property has passed its interview and you have passed yours, does the underwriter combine the two stories. They take the property's net operating income from the T12 and your proposed loan payment to calculate the most important metric in all of commercial lending: the debt service coverage ratio, or DSCR. This ratio simply asks, does the property generate enough income to pay its bills plus the new mortgage? A ratio of 1.0 means the income exactly equals the mortgage payment. Lenders want to see a ratio of 1.25 or higher, meaning the property generates 25% more cash than is needed to pay the mortgage. This is their margin of safety. They combine all this data, the property's value, your financial strength, the deal's cash flow, and they make a final decision. It's a complex, invasive, and exhausting process. But it's not a mystery. They're just looking for a good property and a good borrower. Now that you know exactly what they're looking for, how do you present it? You don't just email 27 separate attachments and hope for the best. Pros don't do that. Pros package this information in a way that makes the underwriter's job easy, that makes them want to approve your loan. In the next part, we are going to build the perfect loan package piece by piece. I'll show you how to assemble these documents into a professional presentation that will put you at the top of the pile, and I'll give you the one-page executive summary template that I use to introduce every deal, a summary so powerful it can get you a yes before the underwriter even looks at a single tax return. Alright, let's break down this one-page executive summary. Think of it as the movie trailer for your deal. It has to be exciting, concise, and make the lender desperate to see the full feature film. If this one page doesn't grab them, your 3-ring binder full of documents will just become a paperweight on their desk. This document is your first impression, and in commercial lending, it's often your only impression. The template is divided into 5 core sections. Get these right, and you're already ahead of 90% of the competition. First, the project overview. This is your 30-second elevator pitch in writing. It should be no more than 3 or 4 sentences. You need to state exactly what you're doing. For example, we are seeking a $3 million acquisition loan to purchase the Maplewood Apartments, a 24-unit, Class B multifamily property located in the rapidly growing submarket of Northwood, Denver, Colorado. See that? In one sentence, the lender knows the loan amount, the asset, the unit count, the class, and the location. The next sentence should be your value proposition. Why this deal? Why now? The property is currently 95% occupied, but with rents 15% below market. offering a significant value-add opportunity through strategic interior upgrades and improved management. Boom! You've just told them how you're going to make money. The second section is the sources and uses table. This is the simplest, most powerful financial snapshot you can provide. It's a 2-column table. On the left, sources, which is where the money is coming from. This will typically have 2 lines, lender's loan and sponsor equity. On the right, uses, which is where the money is going. This will have lines like purchase price, renovation budget, closing costs, and operating reserve. The key rule here is simple but non-negotiable. The total of your sources must equal the total of your uses, down to the penny. If it doesn't balance, it tells the lender you lack attention to detail, which is a death sentence for a deal. This table instantly shows the lender how much skin you have in the game and that you've thought through the entire capitalization of the project. Third, key financial metrics. This is where you speak the lender's language. You don't need a giant spreadsheet here, just the 4 or 5 numbers that matter most. You'll list the purchase price, the loan-to-value or LTV, which is the loan amount divided by the property's value. You'll list the debt service coverage ratio, or DSCR. We've talked about this, but here you'll show it both for the property as is and your projected DSCR after you've made improvements. Showing that before and after is incredibly powerful. It tells the story of your business plan in numbers. For example, current DSCR, 1.25x. Stabilized DSCR year 2, 1.55x. The lender can immediately see the upside and how their loan gets safer over time. You might also include the cap rate on purchase and your projected stabilized return on investment. Keep it clean, keep it simple. Fourth, and this is where so many people fail, is the sponsor profile. This is about you. You are selling yourself as much as you're selling the property. You need a concise paragraph that establishes your credibility. If you have experience, lead with it. John Smith is a real estate investor with over a decade of experience, having successfully acquired and repositioned over 200 units in the greater Denver area. If you're new, you need to reframe your experience. Don't say, "I'm a first-time investor." Say, "Led by a former project manager with a decade of experience managing multi-million-dollar construction projects, our team brings a rigorous, data-driven approach to asset management." See the difference? You're leveraging relevant skills. Highlight your team. If you have a great property manager, lawyer, or contractor, mention them. You're showing the lender that you've surrounded yourself with an experienced team that can execute the business plan. This section de-risks you in the lender's eyes. Finally, the fifth section, the exit strategy. How does the lender get paid back? Lenders are not your partners. They are not in it for the upside. They are in it for the safe return of their capital plus interest. You need to spell out your plan. Our primary exit strategy is a cash-out refinance in year 3, upon stabilization of the property and capture of the higher market rents. A secondary exit strategy is the sale of the stabilized asset. This shows you've thought beyond just buying the property. You have a clear plan for the entire life cycle of the loan. That's it. Project overview, sources and uses, key metrics, sponsor profile, and exit strategy. All on one single page. Clean, professional, and powerful. It respects the lender's time and gives them everything they need to make an initial decision. Now, this one-page summary becomes the cover letter, the absolute first page of your full loan request package. The rest of the package is where you provide the detailed proof for everything you claimed on that first page. The one-pager makes the promise. The full package delivers the evidence. So what's in that full package? First, you'll include a more detailed property description. High-quality photos are non-negotiable. Show the exterior, the common areas, and examples of the unit interiors. Include a detailed breakdown of the unit mix, how many 1-bedrooms, 2-bedrooms, and so on. Next comes the financial deep dive. This is the guts of the operation. You'll need the property's trailing 12 months of operating statements, often called a T12. This shows the actual historical performance of the property. You'll also need a current rent roll, which is a detailed list of every tenant, what unit they're in, what they pay in rent, and when their lease expires. This is one of the most scrutinized documents in the entire package. It has to be accurate. Then you'll include your pro forma. This is your financial projection for the next 3 to 5 years. This is where you model out your business plan. You'll show how you're going to increase rents, reduce expenses, and what the property's performance will look like after your improvements. A word of caution: be conservative and be realistic. If your pro forma shows you doubling the income in 6 months, you'll lose all credibility. Your assumptions need to be backed by data, which brings us to the market analysis. You need to prove that your projections are achievable. You'll include rental comparables. What are similar? Renovated apartments in the area renting for? You'll include sales comparables to justify your purchase price. You should also include a brief write-up on the neighborhood, the city, and the local economy. Are jobs growing? Is population increasing? You're painting a picture of a thriving market that will support your investment. After that, you'll include the documentation on the sponsorship team, that's you and your partners. This means a personal financial statement for each guarantor, which lists all your assets and liabilities. You'll need a schedule of real estate owned, or SREO, which details any other properties you own. And yes, you'll need the last 2 to 3 years of your personal and business tax returns. This is all about verifying your financial strength and experience. Putting this package together is a lot of work, but it's the price of admission. A sloppy, incomplete package signals a sloppy, unprepared operator. A professional, well-organized, and comprehensive package, fronted by that killer one-page summary, tells the lender that you are a serious professional who respects their time and their capital. It shows that you've done your homework and that you are a low-risk bet. It transforms you from just another applicant into a potential partner. You've built the story, you've provided the evidence, and you've submitted the package. Your work is done, right? Wrong. In many ways, it's just beginning. Because now, your deal goes into the black box. It goes to the underwriter. The underwriter's job is not to approve your loan. Their job is to find every possible reason to kill it. They are the gatekeeper, the final boss. And in the next part, we're going to arm you for that fight. We're going to dissect the underwriting process from the lender's point of view, revealing the stress tests they run, the hidden assumptions they make, and the red flags they're searching for, so you can anticipate their every move and ensure your deal makes it to the closing table. All right, let's pull back the curtain and enter the underwriter's office. This is the room where your deal either gets the green light or dies a quiet death on a spreadsheet. The first thing you have to understand is the underwriter's primary motivation. It's not to help you buy a building. It's not to be your friend. Their one and only job is to protect the lender's capital. They are professional skeptics, paid to find the holes in your story. Your job is to present a story so airtight, so well supported by facts and data, that there are no holes to find. So when your loan package lands on their desk, they immediately break it down into 3 core pillars of risk: the property, the borrower, and the market. They scrutinize each one separately, and then they analyze how they all interact. Let's start with the property, the physical asset they're lending against. You might see a building with a certain monthly income. They see a collection of individual risks. First, they rip apart your rent roll. They aren't just looking at the total income. They're looking at the quality and stability of that income. They'll ask, who are the tenants? Is it one big tenant making up 80% of the income? That's a massive red flag called tenant concentration risk. If that one tenant leaves, the property instantly goes from profitable to a money pit. They'd much rather see 20 smaller, diversified tenants. They'll also check the credit of your major tenants. Is it a Starbucks with a corporate guarantee? Or a local business that just opened last month? That matters. Next, they look at lease expirations. Do all your leases expire in the same year? Another huge red flag. That's called rollover risk. If the market softens that year, you could face a mass exodus of tenants and a sudden catastrophic drop in income. A staggered lease expiration schedule, with leases ending in different years, is a sign of a stable, well-managed property. Then comes the part that trips up most beginners: the expenses. The underwriter takes your projected expenses, the ones on your beautiful pro forma, and they essentially throw them in the trash. They do not trust your numbers. They assume you've been overly optimistic to make the deal look better. So they perform what's called stabilizing the expenses. They will substitute their own, more conservative figures. You say the management fee is 4%? They'll say, in this market for this asset class, we underwrite to 5%. You say vacancy is 3%? They'll look at market data and say, the submarket average is 7%, so we're using 7%. The most important one is capital reserves. You might have $0 budgeted for future roof repairs or parking lot repaving. The underwriter will plug in a standard figure, maybe 25 or 50 cents per square foot per year, as a non-negotiable expense. Why do they do this? Because every dollar they add to the expense line is a dollar that comes directly off your net operating income, or NOI. And since the loan amount is based on the NOI, this expense haircut directly reduces the amount of money they are willing to lend you. This is often the single biggest reason why the final loan amount is less than what the borrower initially expected. The second pillar is you, the borrower. They need to know if you are a reliable and capable operator who can weather a storm. This is called the global analysis. They start by pulling your credit report, but that's just the beginning. They want to see your personal and business tax returns for the last 2 to 3 years. They are looking at your global cash flow. Do you have other sources of income? Do you own other properties, and if so, are they cash flowing positively? If you have another property that's losing money, they see you as a bigger risk, because you might be tempted to pull cash from the new property to prop up the failing one. Then they look at your liquidity. This is non-negotiable. After you've paid the down payment and all your closing costs, how much cash do you have left in the bank? This is your post-closing liquidity. Lenders need to see that you have a safety net. If the air conditioning system for the entire building dies a month after you close, they need to know you can write a check for $50,000 to fix it without missing a loan payment. A typical requirement is 6 to 12 months of principal and interest payments held in liquid assets. If you don't have it, the deal is dead. And of course, there's experience. Have you done this before? Do you have a track record of successfully operating this type of property? If you're a first-time investor buying a 50-unit apartment complex, they're going to be nervous. The way to overcome this is to have a bulletproof team. If you can show them you've hired a highly experienced, professional third-party property management company with a great track record in that specific market, you can mitigate their concerns about your own lack of experience. Your team's experience becomes your experience. The third pillar is the market. Your property doesn't exist in a vacuum. The underwriter will pull detailed third-party market and submarket reports. They want to know everything about the few square miles surrounding your property. What are the population growth trends? Is the local economy growing or shrinking? What are the major employers? Is a big company about to move into town? Or is one about to leave? They'll look at competing properties. What are their vacancy rates? What rents are they achieving? If your pro forma projects rents that are 20% higher than the identical building across the street, you better have a spectacular explanation for why. They are looking for reasons to doubt your projections, and an unhealthy market is a giant flashing red light. Now, once they've analyzed these 3 pillars, they bring it all together for the final exam, the stress test. This is where they try to break your deal. They run a series of what-if scenarios. They'll ask, what if interest rates rise by 2% when this loan needs to be refinanced in 5 years? Will the property's cash flow still be able to cover the new, higher debt payment? What if a local employer shuts down and vacancy spikes to 20%? What if operating expenses increase by 10% due to inflation? They will plug these harsh assumptions into their model. Your deal must continue to cash flow even under these stress conditions. It has to maintain a debt service coverage ratio of at least 1.0, meaning it can at least break even under this financial storm. If it can't, the deal is too risky. They will either reduce the loan amount to a level that can pass the stress test, or they will decline the loan entirely. Understanding this process, the focus on quality of income, the expense haircut, the global cash flow analysis, and the stress test is the key. You're no longer just submitting an application. You're pre-underwriting your own deal. You're anticipating their objections and providing the answers before they even ask the questions. You're building a case so strong, so well documented, that when the underwriter looks at it, their skepticism is replaced by confidence. They see not a risk to be mitigated, but a smart, well-structured investment for the bank. And that is how you get to the closing table. But getting the yes from the loan committee is only half the battle. Now you have to actually close the deal. A process filled with its own unique set of traps and legal minefields. From reviewing title commitments and surveys to navigating the final, frantic days of closing, one small mistake can cost you thousands or even delay your entire project. So now we need to walk through that final gauntlet step by step, to ensure you cross the finish line and finally get the keys to your new property. The first critical step in this final phase is the pre-closing walkthrough. Do not, under any circumstances, skip this. This isn't a friendly visit, it's a final inspection. You're verifying that the property is in the exact condition you agreed to buy it in. You're checking that no equipment has been swapped out, no new damage has occurred since your last inspection, and that any contractually obligated repairs have actually been completed to standard. Imagine signing on the dotted line, getting the keys, and then discovering that the seller swapped out the high-efficiency HVAC units for older, cheaper models overnight. It happens. Or finding a brand new leak in the roof of a warehouse that wasn't there a month ago. At the walkthrough, you still have leverage. The seller wants their money. Once the deal is closed, that leverage vanishes. Go through with a fine-tooth comb. Test the lights, run the water, flush the toilets, check the appliances. If it's a multi-unit property, try to get a look at as many units as you can. Any discrepancy you find needs to be addressed before you sit down at the closing table, usually in the form of a credit from the seller. Once you're satisfied with the physical state of the property, you'll face the final boss of paperwork, the closing statement. This document, often called an ALTA settlement statement or a HUD-1, is the master ledger of the entire transaction. It's a detailed line-by-line breakdown of every single dollar changing hands. It shows where all the money came from and where it's all going. Seeing it for the first time can be incredibly intimidating, but it's just accounting. Your job is to be the auditor. You'll see two columns: debits and credits for both you, the borrower, and the seller. A debit is money you owe. A credit is money you're receiving. Your biggest debit, of course, will be the purchase price of the property. Your biggest credit will be the loan amount from the bank. The goal is to have these two columns balance out perfectly, resulting in the final cash to close figure, the amount of money you need to bring to the table via a cashier's check or wire transfer. Before you even think about signing, you need to pull out your loan estimate, that document you received way back at the beginning of this process, and compare it to the closing statement. The fees should be substantially the same. Look for any new unexplained junk fees. Scrutinize the loan details. Is the interest rate exactly what you agreed to? Is the loan amount correct? Is the term right? A single typo here could cost you tens of thousands of dollars over the life of the loan. Then you dig into the prorations. This is where expenses are split fairly between the buyer and seller based on the closing date. Property taxes are a big one. If the seller has already paid the property taxes for the entire year, you'll owe them a credit for the portion of the year that you'll own the property. Conversely, if the taxes are due later, the seller will give you a credit for their portion of the year. The same logic applies to things like condo or HOA fees, and most importantly for commercial properties, rents. If you close on the 15th of the month and the seller has already collected rent for the full month from all the tenants, they owe you a credit for the second half of that month. You need to verify that all collected rents and security deposits are being properly credited to you at closing. Don't trust, verify. Have your attorney review it, and you review it yourself. This document tells the story of your deal. Make sure it's telling the truth. Now, a quick but important distinction you might encounter is the concept of a dry versus a wet closing. In a wet funding state, which is the majority of the US, everything happens at once. You sign the documents, the lender wires the funds to the title company disburses the money to the seller, and the deal is officially closed and recorded, all on the same day. You walk out with the keys. However, in a dry funding state like California or Alaska, the process is split. You'll sign all the documents, but the money doesn't move yet. The signed package is sent back to the lender for a final review. Only after they give the final approval, which could be a day or two later, do they wire the funds. The deal isn't technically done until the money moves and the deed is recorded. It's a crucial difference to be aware of, as it affects your timeline and when you can officially take possession of the property. So you're at the closing table. Who's in the room? Typically, it will be you, your attorney, the seller, their attorney, and a representative from the title or escrow company who acts as the neutral third party, the conductor of this orchestra. Sometimes a representative from the bank is there, but often they just work remotely with the title company. The atmosphere is usually professional, sometimes a little tense, but it's not a negotiation. All the negotiating is done. This is the execution phase. You'll be presented with a mountain of documents. The big ones are the promissory note, which is your personal promise to repay the loan, the mortgage or deed of trust, which is the document that pledges the property as collateral for that loan, and of course the closing statement. You'll sign your name so many times your hand will cramp. Take your time. Ask your attorney to explain anything you're not 100% sure about. This is your last chance. Once the last signature is down, the magic happens behind the scenes. The title company, having received the funds from both you and your lender, will perform a final title search to make sure no new liens have been filed against the property at the last second. Once that's clear, they get the green light to fund and record. They'll wire the payment to the seller and pay off any of the seller's existing mortgages. Then, a courier literally takes the new deed and mortgage documents to the county recorder's office. A clerk at that office stamps the documents, entering them into the public record. That stamp, that simple physical act, is the moment you officially legally become the owner of the property. The title is now in your name. The keys are yours. But your work isn't over. In fact, in many ways, it's just beginning. The moment you leave that closing table, you are a commercial landlord. There are immediate post-closing tasks you need to handle. First, transfer all the utilities into your name. Second, send a formal written notice to every single tenant. This letter should introduce you as the new owner, provide your contact information, and, most importantly, clearly state where and how they should pay their rent starting next month. You also need to confirm you've received all their security deposits from the seller. Third, if you're using a third-party property manager, now is the time to officially hand over the reins. Fourth, set up dedicated bank accounts for the property, one for operating expenses and receiving rent, and a separate escrow account for holding tenant security deposits, as required by law in most states. Finally, take that thick folder of closing documents, make digital copies, and store the originals somewhere safe. Put key dates in your calendar: your first mortgage payment due date, property tax deadlines, and insurance renewal dates. And with that, you've done it. You've navigated the entire, complex, and often grueling process of securing a commercial real estate loan. We started this journey by understanding why commercial loans are so different from residential ones, focusing on debt service coverage ratios and the income the property generates. We delved into the different types of loans, from conventional and SBA loans to hard money, choosing the right weapon for your specific deal. We walked through the brutal forensic examination of underwriting, where every detail of your financial life and the property's potential is put under a microscope. We assembled a team of experts, your broker, your attorney, your inspector, who became your guides and protectors. We survived due diligence, negotiated terms, and finally, we crossed the finish line at the closing table. This process is a marathon, not a sprint. It's designed to test your resolve, your attention to detail, and your patience. But it's not black magic. It's a system. And now, you understand that system. You have the blueprint. The knowledge you've gained through this series puts you ahead of 99% of aspiring investors who are too intimidated to even start. Getting the loan and closing the deal isn't the end goal. It's the key that unlocks the door to building real generational wealth. But this is just the first door. Now you have to manage the asset, optimize its performance, and eventually scale your operations. If you're ready to learn how to turn this one property into a true portfolio, how to maximize cash flow and force appreciation, then make sure you're subscribed to this channel. This series was the foundation. What comes next is how we build the skyscraper. Thank you for taking this journey with us. Welcome to the club. Now go build your empire.